Welcome back to another episode of Multifamily AP 360. And our today's guest is Benjamin Carmona from Perch Wealth. Welcome, Ben.
Thank you. Thank you, Rama. It's great to be here.
Sure, absolutely. And a little bit about Ben. Ben, with over 20 years of expertise, Ben is a leader in 1031 exchanges, Delaware Statutory Trusts, and innovative real estate investment strategies. Having worked with top firms like Cantor Fitzgerald, Next Point Advisors, and Capital Square Advisors, he brings unmatched experience in acquisitions, finance, due diligence, and product syndication. Ben's in-depth knowledge spans structured 1031 products, including TICs, DSTs, non-listed REITs, pet equity, and more. His strategic insights into alternative investments and the financial industry makes him a trusted advisor for clients seeking tailored, informed investment solutions. With that, Ben, you want to add anything?
No, you summed it up. In short, I'm a financial advisor. I'm securities licensed. I'm not your traditional advisor that's doing stocks, bonds, and mutual funds and annuities. I am solely focused on private real estate syndications, whether they be 1031 exchange related or in other syndications for cash investors, if you will.
Awesome. Thank you. So how did you get into this space?
I always knew I wanted to be in the real estate world. I grew up in a family. I mean, my dad owned a foreclosure company. He owned multifamily, and now he's a private lender. So it was always an aspiration. And out of school, I stumbled into it. I was referred by somebody, and who would have known at that time? I had no idea that real estate syndications on the security side even existed. So I stumbled into it almost 20 years ago, right out of school, and I've been in it ever since in a variety of different capacities.
Awesome. Thank you very much. So 1031 exchanges have been a cornerstone of wealth building for real estate investors. So what's the biggest misconception people have about 1031 exchanges, and how do you help investors maximize their benefits or profits?
Sure. I'll start by, and I'll get to the misconception. I'll start with, and maybe your audience is already familiar, Ram, but 1031 exchange is like the most, I would say, powerful tax mitigation solution or in the tax code. It's been around for 100 years, right? And allows investment property owners that have appreciated real estate to sell their properties and defer paying any taxes associated with the gains as long as you buy other replacement property or other investment property with the proceeds. So you can exchange from one property to another, you can exchange on down the line. So it's a very powerful tool to preserve. The biggest misconception, I would say, there's this in the code, it says you have to exchange like-kind property, right? So if you sell a multifamily, the misconception is that you can only buy a multifamily, right? But that's not accurate. It's actually investment property for investment property. So you could sell a multifamily and buy raw land. You could sell raw land and buy a hotel. It just has to be classified as investment property.
Awesome. Thank you very much. And there are many ways to execute 1031 exchanges, right? Takes DSTs and structured private equity options. How should investors determine which strategy best fits their financial goals?
Yeah, I mean, look, a traditional 1031 exchange, which still represents the vast majority of exchanges today, is just you, Rama. If you sell one of your properties, you go out and find another property, and you just, you sell one, you buy another one direct, right? That's how that's the traditional path. And I will say, and we don't have time to get into it, but the IRS has blessed us with this opportunity to defer taxes, but they don't make it easy, right? So there's timeline limitations and several different rules that need to be followed. And those rules aren't always easy to satisfy to complete an exchange. But so that's the prototypical or traditional way. DSTs, Delaware Statutory Trusts, is just another investment structure that satisfies a 1031 exchange. And so when you ask the question, and I'll get into DSTs, ask the question, which avenue is best? I would say, just broadly speaking, look, most younger folks, maybe sometimes up to 60, that are still shaking and moving, and they're in real estate, and they like to buy and sell, and they want to manage. You're gonna more times than not, they're gonna do a traditional exchange, right? Because they want to be involved. for the folks that don't want to be in active management anymore, right? And these are my clients. They've already done well. They've owned real estate for 20 to 50 years. They're tired of active management, and they're hoping and dreaming and praying for a solution that will allow them to sell their properties, defer taxes, get out of active management, and collect stable, predictable income stream for the most part. Those are my clients, and those clients would probably be very attracted to the DST, Delaware Statutory Trust. And so I don't want to keep, is it okay if I just explain them real quick?
Yes,
okay.
yes.
So Delaware Statutory Trust, and for the audience that's not aware of them, don't feel bad, because 95% of the world and country has no idea what DSTs are. But the structure itself is, in 2000, or in the 80s, the DSTs were created in the 80s, right? And it's a trust. And it's a trust whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners, right? And then when they were set up, they weren't set up for 1031 purposes at that time. But when you apply this trust around real estate, it creates a situation where you fractionalize ownership, right? You have lots of investors own direct but undivided interest in a property or properties. So in 2004, the IRS actually came out and said and validated this type of fractionalized ownership as it constitutes as real property, and therefore eligible to satisfy exchanges. So it's a trust that holds title to real estate, and you can have lots of investors be investing in it. And so that's what it is in a nutshell. Now, I'll give you an example. In my world, there are sponsors. The sponsors are big real estate companies. It could be Apollo, it could be Starwood, it could be Cantor Fitzgerald or Inland. There's 50 of these sponsors that play in this space. Big real estate companies, they go out and they use their resources, their relationships, their capital, and they'll buy a $100 million multifamily asset in Dallas, Texas, right? Fully stabilized, 98% occupied, income producing. They may have bought a $50 million self-storage in Raleigh, North Carolina, or a $75 million healthcare campus in Orlando, Florida. So you have these real estate companies buying institutional quality real estate on their balance sheet, and then turning around and offering it to retail investors like you and I and my clients who are in exchanges, right? They're selling a property, and they don't want to, if they sell a property and buy another property, it doesn't solve their problem. They don't want to manage anymore. A client, Rama, if you sold one of your multifamily assets, you could take the proceeds from sale and satisfy your exchange through investing in one or many of these DSTs. And they're already owned. They're stabilized, they're income producing. Some have leverage, that's all non-recourse, some don't. And so I'll just finish with this one example. Little Mrs. Smith, my client, who sells a triplex in LA or Orange County or wherever, $2 million. I could take Little Mrs. Smith's money and I can mitigate risk, because I can put $300,000 into the medical office, $500,000 into the multifamily, $200,000 into the storage, so on and so forth, and really create a diversified portfolio that is generating monthly income. And she doesn't have to do anything, no more management. And 8 out of 10 times, I'll say that in doing so, we're able to increase income for the client, and again, add on those other benefits associated.
Got it. Yeah, thank you for explaining that. So DSTs have gained traction as a passive investment strategy. So how do DSTs compare to direct real estate ownership in terms of risk, control, and tax advantages?
Yeah, great question. I'll start with tax advantages, the same, right? So if you're talking not only the tax deferral, but depreciation benefits, right? It's same exact taxation situation. Even upon death, you get a step up in cost base. Compared to direct real estate, there's a couple things I'll just touch on. Number one, without question, and I'm just upfront about this, there are more fees associated with DSTs than there are with a direct real estate acquisition, right? Why? Because there are a lot more players involved. I'm involved as an advisor, right? I need to be compensated. The sponsors, the real estate companies, are taking acquisition fees and their syndication costs, and those are unavoidable, right? So just right from the get-go, DSTs are going to be more expensive. To balance that out, I would say that, again, there's risk in everything, of course, but the conversation, or at least an example, would you rather own a piece of a 400-unit multifamily project in Dallas, Texas, that's managed by a multi-billion-dollar asset manager, or maybe one property with one tenant, or a property with two tenants, right? So you got 400 tenants in a great market. The direct real estate could be in a great market. You have two tenants. If you lose one, it's going to impact you. If you lose 5, 6, 10 tenants in a 400 unit, or 20, you don't really feel that burden. Then also from a due diligence and underwriting perspective, because these are securities, there is so much due diligence and compliance and legal and scrutiny applied to these, far and above what you would traditionally do in a direct purchase. So there's good and bad. Look, if you're a syndicator and you know what you're doing and you have a great niche, there's no reason for you to get into DSTs, right? And we deal with a lot of syndicators that are retired, and they're like, look, I don't need to make 15, 20% returns anymore. I am cool with a 5 or 6 or 7. I don't want to deal with it anymore. And so hopefully that gives you a little.
Yeah, thank you. From a legal perspective, from a subscription document or private placement memorandum, how exactly you guys will coordinate with sponsors and also passive investors?
I'm sorry if I understood. How do we compare like the PPMs and the sponsors?
Yeah.
Okay.
Yeah.
Okay. So that's where. So today, my company is Perch Wealth. I am a financial advisor, and I represent clients. I recommend investments. Prior to starting Perch Wealth, I spent 15 years on the sponsor side of the business, or the investment syndication side of the business.
Yeah.
So I know the players in the space inside and out. I put these deals together, and I know the fee structure. I know how these folks have treated investors in good or bad times. There's so many variables in the world that we operate in. And that's the competitive advantage, I'd say, that we have, is that, and again, there's risk in everything, but of the 100 different offerings in the market at any given time, like I can sweep off 70 right off the bat, because I know, look, these have inherently more risk, or I don't like the way they work, so on and so forth. And yeah, there's a lot of underwriting that we do on our side, combined with my industry experience and knowing all these folks.
Yeah, got it. Thank you very much. So would you share any best and challenging experiences in implementing or executing DSTs?
Oh, 100%. I've seen the good, the bad, and the ugly. And I'll tell you, out of school, I walked into this space as a spring chicken, the newbie. I didn't know what I was doing. In 2006, and I walk into this, I was on the sales side then, this war room, if you call it, and it was like the most exciting thing ever. Our biggest problem was making sure there was enough paper in the fax machine to process all the business that was going on, literally. And that was so much fun. But then 2008 hit, and the industry got crushed, like all real estate. And that was a blessing for me. And that was when I really, like, I need to understand these products. And so, yeah, I dove right in, and I love this, even to this day, looking and analyzing offerings. And even past that, there's been companies I've been with, that I've been represented, that have really screwed up on deals. It's screwed up. So I've seen so many things go wrong, which is good at the end of the day, right? You don't know what you don't know until you experience it. And I've experienced a lot. As today, as an advisor, having been 4 years on the advisor side, and I have a team of 11, and I have a business partner. We've placed definitely over 500 million of equity on behalf of investors. And there are some deals that are challenged. They're not going to go bad, but distributions have been cut. So there's always going to be issues. It's, in my opinion, it's about mitigating risk as much as you can, maximizing income for our clients, of course. And yeah, I don't know if that was a clean response for you, Rama, but
yeah, that's fine. So given today's economic landscape, high rising or high interest rates and market uncertainty, and what investment strategies are helping your clients protect and grow their wealth?
Great question. So I'll tell you, I was incredibly bearish on the economy incredibly bearish. I'm still have my own concerns, but like it or hate them, the new administration, I feel much better with them in running the show. So I'm optimistic, but still cautiously optimistic. What I've always told my clients, and I still to this day, again, my clients for the most part aren't looking to get rich, they're looking to stay rich, if you will. And so it's always about investing in defensive, resilient, necessity-based strategies, right? Whether it's multifamily or healthcare related properties, or even single tenant triple net lease product, but with tenants that are necessity based. I don't want a discretionary type of business in today's market. There's just too much uncertainty, right? I want a tenant that provides necessity based goods. And then even I'll just throw one out, or self storage is pretty resilient. But like today, I love mineral rights, oil and gas mineral rights in the Permian Basin. I invest quite a bit. And so there's various strategies, but it's all about mitigating risk. And I tell my clients, look, I view the world through a bearish lens, through a worst case scenario lens, because if things go to hell in a handbasket, I want to make sure, or try to make sure that our properties are among those last standing.
Thank you. What kind of asset classes you are focusing for your client in next 5 to 10 years?
What I recommend going into?
Yeah, what kind of asset classes?
Yeah, look, multifamily, I love multifamily. Right now, broadly speaking, multifamily is fairly soft, right? There's been so much inventory added to the market, but and that's a result of the very low interest rate environment we had for 10 years, right? These developers are going crazy. They build everything they can, that money was so cheap. But now that interest rates are up and construction costs are where they are, it's much harder to make the numbers work. So the development pipeline is way down. So as soon as the excess inventory in all these markets gets gobbled up, and that will happen naturally in the next 18 months, we'll call it, it's going to be a landlord's market again. So I like multifamily long-term, necessity. Again, the senior housing, right? You follow demographics today. We have an aging population, baby boomers and seniors. They need assisted living and memory care and those types of sectors. So there's going to be massive demand. That's a sector I want to be in, but you have to be very careful. You have to find good operators, of course. And energy, I mentioned it, unless you think oil and gas is going to go away tomorrow or in the next 50 years, I think to be involved or diversified into energy is amazing.
Awesome. Thank you very much. Let's shift towards personal side. So any habits that are helping you to be successful?
I'm sorry, repeat that. What to be successful?
Any personal habits that are helping you to be successful?
Oh, yeah. It's funny. I'm not the brightest, the sharpest, what do they say? Sharpest tool in the shed. Just my intelligence never got me. I mean, it wasn't, yeah, my intelligence didn't get me to where I am and what we're doing today. It's sheer hard work, right? Knowing the business inside and out, being honest and genuine with people. Yeah, and really being a student of the business that you're in. It's hard work, is what I'd say.
Awesome. Thank you. Share me any one personal learning that created major impact on your personal life or your business life. Any one learning. Yep.
Any moment or experience that had a big impact on my life. Geez, there's so many, but let's see if I can think of one. This just came to mind. I used to want to be like you're building your portfolio and you're doing the syndications and whatnot. I used to think I want to own a bunch of rentals and I want to own this big portfolio. It sounds great, but I'm in California, and in California, you as a landlord, you are guilty until proven innocent. It's a horrible market to own. It's tough. And so I did own many years ago a laundry mat with a couple of apartments, and it was a disaster. It was just a disaster with the tenants and the laws and ADA compliance and everything. So that impacted my real estate investment strategy going forward. I don't own rentals anymore. It's not for me. May not be a very powerful moment, but it's what came to mind.
Got it. Thank you. So any books that impacted you?
You know what? I just asked this the other day too. This won't be a very good answer. Other than the Bible, I'm not a huge book reader. I am talking to so many people, whether it be the Wall Street Journal, but I'm talking to brokers and retail investors and sponsors and lenders every single day. It consumes every day. And that's where I get a lot of my market information, right? Real time. That's the best place to get it. Yes, that's what I'd say there.
Cool. So how can listeners can connect with you, Ben?
How can what? Investors connect with me?
Yeah.
So I'll just give you my cell phone. My cell phone is 818 area code 269-4972. Again, I'm based in Orange County, California. My office is in San Juan. My email address is bcarmona@perchwealth.com. As I mentioned, we have advisors all over the country: Georgia, Texas, Florida, California, Arizona, Ohio. And yeah, we'd love to speak with you. If you just have questions about 1031 exchanges, or you're in an exchange, whatever it may be, if we can help, we're happy to do so.
Awesome. And thank you very much, Ben. Thank you.
Thank you, Rama. It was a pleasure. Appreciate it.